Happy to have Michael Kantrowitz, a.k.a. Kantro, join the On the Tape podcast. Michael is the chief investment strategist at Piper Sandler and leads the portfolio strategy team. I might add, #1 II ranked team. And in the world of Wall Street and awards, it's probably the most meaningful one. So congratulations for that. All right, Mr. II #1, before we get into all this, give the viewers and listeners a little bit of your background because you have a lot of experience here.
Yeah, age creeps up on you. My kids are almost ready for college, so
you look young. You look good.
Oh, well, thank you. Yeah, thank you. Yeah. Considering most of my career now is post GFC, and I feel like every couple of years there's just. By
the way, this is what happens when you stay too bearish too long. I'm actually only 30 years old. Anyway, please go. Yeah.
So I've been doing this about. I started in research in 2004. Started at Merrill Lynch on a small cap research team. And I've been in macro quant strategy my entire career. I left Merrill in early 2007 because obviously I knew, just like you, what was about to happen.
Of course.
Right. In fact, I was actually about to join a small cap banks team. Okay. True story.
Yeah.
And so anyway, sliding doors went the right way. I joined ISI Group, worked there for a number of years in the strategy team. We left there, worked at Wolf Research for a few years. And then in 2013, we started Cornerstone Macro, was there for about a decade. And Piper Sandler acquired Cornerstone Macro in 2022. So it's been almost, I can't do the math here, 23 years.
And you've worked from very smart people too. So
yeah, I've been super fortunate to work with a lot of smart people, to be exposed to our clients who, help me learn. And the fun part about this job is that you're learning every day. And, we're talking about tariffs and the budget deficit today. We were talking about oil break-evens in 2015. What are we going to learn? What are we going to be talking about in 6 months? Probably something new.
Give me your most recent thoughts. And I want to tell people out there that you've launched a podcast. You launched it with your quant partner, Stephen Gregory at Piper, right, called What's Next for Markets, which is weekly, started in January. Yeah. And by the way, it's great. So thank you for that. So I know what's next for markets because I listened to you this morning, but why don't you give us a current update on what you're thinking about the world here?
Sure. So there's, I can't remember a time where the market's been so myopic and reactive. I've always had the view after 22 years on the street that the markets aren't as forward-looking as we all want to believe or are certainly taught. But this has really put an exclamation point on that. So, where do you want to start?
On April 6th, you wrote a report called Markets Are Terrified,
yep,
but you also wrote What Could Go Right.
Yeah.
And you talked about how a lot of it's going to be noise. And I think you and I were under the same logic that you can't implement these things because you can't trade that. There would be no way. So let's talk with that, since that's kind of the most recent, we've gone through about a month and a half of this now at this point, and the ups and downs. And what made you think that? And what clarity have you gained since then?
We were focusing on what could go right, really from Liberation Day through when finally something went right on the pause. And the way I was thinking about it, one, we tried to frame it in a bit of a parallel to 2022 with respect to the market going down because of inflation. So if you look back in 22, the market basically bottomed twice. It hit a bottom in June when oil peaked, and then oil started going down. Of course, oil was related to inflation back then. Of course, it always is. And then we ultimately had the peak in October of 22. What happened there? CPI started coming down. So after that period of time, I did a lot of work going back and looking at every single time basically the market pulled back over 10% or more. Bear markets, everything back to the 60s. And what I realized that there was in each one of those market pullbacks, there was a primary issue that even, I'm sure during the time, and I lived through many of them in the last 20 years, that was what the market was focused on. And 2022's bear market, which I ended up staying too bearish too long on that, and this is really what led me to learn my lesson and play this out this year, is that when that primary issue stops getting worse, and we know this was Trump just hammering tariffs. As soon as you got some good news, didn't matter what it is, just had to be good news, the market was going to bottom. And forget about and put aside all your secondary and tertiary fears beyond there. We're going to go into recession. We're going to have inflation. The Fed's going to hike, and all those issues. Ultimately, all you needed was something incrementally to go right. And the weekend of before the pause, it was the 6th, the 7th of April. I remember we put a list together and said, well, here's what could go right. Because the bearish case was obvious. Trump's going to just keep hammering tariffs. The narrative by then, everyone believed that he wanted to send the economy into recession to get rates down. And that all just seemed a bit too much of a pipe dream and unrealistic and unproductive on the administration. So we put a list together of what could go right. And the two things that I think hit that week, and beginning probably the later part of the weekend of the week before, was bond yields started spiking the Friday before that weekend. And so, and that continued into Sunday night when the market opened up and into Monday morning. And so the two things we put down that could go right is, of course, Trump said anything positive, like literally anything. And the second one was the view that, look, up until Liberation Day, this was really a U.S. market issue. Following Liberation Day became a global issue. So you pissed a lot of other people off, basically, and you brought them into the fold of problematic issues. So that made me think like, well, there's got to be, you start really seeing the global markets collapse. There's more parties interested in putting this issue to rest. That's putting the market down. And so that weekend, the markets, everyone was super bearish. I go on X every once in a while, and I posted this on Sunday night. There was like 15 spaces running at 8 p.m.
Where were the signs, right?
And it was Black Monday, market crash. So on and so forth, economic crash. And like literally, I counted 15 of them, and I tweeted out, this is probably a sign. Again, that wasn't in itself a catalyst, but just you knew where expectations were. And people, what they often do in market downturns is they take the problem, and then as it gets worse, everyone kind of believes in the problem, extrapolating it to get worse and worse and worse. So we just figured, why pound on the bearishness? Because again, it's pretty clear what the issues are. What can change things? And particularly because I hung on to a bearish call too long in 2022. And part of that was because I did think we were heading into recession. But what I actually think I got mostly wrong, besides that, or even more wrong than that, was actually not appreciating the fact that as soon as people thought inflation stopped accelerating, the market was going to bottom and put everything else aside. And that's exactly what happened here with the pause. And that's the lens I was trying to help our clients see through, because that was the behavior. If you go back in all market corrections, that is the behavior. So we did get essentially two things that went right in the sense that Trump paused, and I think a lot of it had to do with the bond market, and that the global markets, all got sucked into the black hole of U.S. equities. And when that pause was announced in the middle of the day on the Wednesday, we published a note as soon as we could: peak uncertainty, recession canceled, market low is likely in unless Trump, makes it worse, which we didn't think he was going to. You kind of hit peak panic, peak hysteria. And so from there, fortunately, we got a string of positive headlines, mostly headlines. Now we're starting to get some action that just kept unwinding all that fear that was built up over, the several weeks leading into the low.
So I've had Vinny and Porter on this podcast many times. And last time they were on, they talked about kind of the Pavlovian response that we've seen. And you agree with Vinny's comment that, it really, all that matters right now is Trump is the straw that's stirring the drink, right? And you have to pay attention to it. But the self-check mechanism of them has been the bond market and the stock market. That's been kind of the check, right? And so this last one we had for a day or two, the European, things like people are becoming kind of immune to it. That being said, there's other things that are driving rates higher, right? We'll talk about the tax bill deficit and things like that. Is about 4.75%, I think you've talked about, as kind of the number that matters the most for the bond market. And explain to people why it's such a financialized, obviously, economy. I think why 4.75? And just, are those factors that you see move off of that number? Or?
That was based on, and it was and
that's a 10-year yield. Sorry, I meant to specify.
Yield, so that was a number that we put out probably at some point in 2024. And that was based off the little history we had leading up until mid-2024 in terms of how the market reacted to higher rates. And in 23 and in 2024, I think a narrative got believed that the U.S. economy and the stock market were no longer interest rate sensitive. And I think this is an example of a bigger issue that is an issue today, I believe, because we have what I would describe as the most bifurcated stock market in terms of fundamental earnings and bifurcated economy certainly in my lifetime, and probably, at least going back as far back as the data go. the question is the economy or the stock market or the consumer sensitive to interest rates gets lost, because when you're looking at the aggregates, you could see the aggregates have held up. We haven't had a recession. The consumers continue to spend. The stock market's obviously gone up a lot since the lows in 22. But under the surface, the bifurcation that we're seeing, I think, is largely a result of higher or more normalized interest rates. And that continues into today. And I think we're a bit trapped between a refinance and a hard landing, a play on a rock and a hard place.
So you talk about the bifurcated market and economy, which we all talk about. And is the wealth effect to that point underestimated or underappreciated? Because it feels like when the market starts to trade down, because it's so bifurcated, if that part of the market and the consumer, let's say of the economy, can't keep spending, then we're in trouble because the market is so bifurcated. Would you agree with that?
Yeah, but the let's call it a K shape. The top part of the K is just much larger than
it's not just because your name's Kantrowitz. It's just the K. You're using the K in general. Okay, I just want to make sure you haven't patented a new thing with the letter K.
I'll have to check with my attorney.
Go ahead. Yeah.
So the top part of the K is much larger and much healthier. And think of consumers. It's larger cap, profitable S&P 500 companies. For consumers, it's the middle upper income and higher. It's homeowners. It's those who are benefiting from savings in higher interest rate environments, own equities, own assets, et cetera. And then the bottom part of the K is those that are paying where the pain is. And so 475 was a level where we thought stocks in aggregate could no longer rise above if rates were above there and rising. And what you often see is that, again, people look at interest rates and then look over the last few years and they're like, look, interest rates are up and the market's up, things are fine. And that's true. However, when you look at interest rates on my Bloomberg, I have one of my favorite charts to show the 10-year and show market breadth. And I love when I can connect a macro idea to a technician's idea. And the biggest driver, explanatory variable of changes in market breadth in the last 3 years has been the 10-year yield going up and down. And what we start to see is when rates start going up. So actually, a good example would be September of 2024, right when the Fed cut 50. The 10-year was at 3.6. A bunch of stocks have hit their peak, and I don't think have moved above those peaks. The same day the Fed cut and the 10-year bottomed. And a lot of them were home builder stocks, the rate sensitives, basically. Some of the biotechs, real estate names. And so as rates started going up from that rate cut, the market went up for another month and a half until it became a problem. We got about up to 4.5, and that's where markets started to struggle. But before there, you started seeing the breadth of the market deteriorate, and it was just Mag 7 left carrying it into the end of December and early January. And we're beginning to kind of see that relationship reconnect now that the tariff volatility has taken a downshift. And the focus besides maybe for during the trading day on Friday with the European tariff announcement, but the focus has been back on bond yields. And in many ways, yes, we have a new administration. We've got a whole bunch of new policies. We've got tariffs. But in many ways, though, I don't think things have largely changed all that much in the macro and market environment. We're still bifurcated. We still have rates around 4.5. The Fed hasn't cut anymore, and they're probably not going to, certainly not aggressively anytime soon. Nothing's really changed. You still have housing in a really difficult backdrop. Small cap earnings are going down for the third year in a row, and you're continuing to see larger cap dominance of the market.
Yeah, I want to get into your hope trade a little bit because that's what you're known for. One of the things that you've been following for some time, which deals with housing. But a question for you back on rates again, because when debt to GDP was manageable years ago, and you've been doing this many years, as long as I have. You didn't have to worry about that side of the equation. Yep. But when rates move higher now, it's not just U.S. businesses, it's the U.S. government at the same time. So I feel like it's a double whammy.
Yep.
So we've seen bits and pieces around the globe, and even here, where it's really hard to tell what's making our rates move higher, right? Oh, you get this tax bill through, great. That's, you get better profits, but, it's going to grow our debt and deficit. Where do you look at that? And where does it start to matter? And I get it. At some point you say, well, you can't trade the end of the world. So how do you do that? How do you balance and figure that out?
Yeah, it's hard to attribute changes in interest rates to deficit fears, because what are we going to quantify? The budget deficit every month or every quarter? That doesn't exactly line up. Of course, bond yields are a global market, so they're influenced by many different economies, like Japan, for example. And so the thing is that every time rates have gone up, and I'll give you a number now, I think we may be beginning the 9th narrative rotation around interest rates since 2023. Maybe 9. We've had 8 so far, and we can walk through a couple of those.
What are we in right now? Which narrative? Because I've seen those.
Japan is going to change how they issue debt, and maybe
which we did with Yellen a couple years ago.
They're not going to blow up, and maybe that's going to put a peak in yields for now.
Gotcha.
But we've gone between recession fears, the Fed's going to be cutting a lot, to no landing, to soft landing, back to no landing, back to a lot of rate cuts, back to no landing, 8 times. And if we've seen a peak in yields now, and we could talk more about that, maybe Japan is the latest headline to change that narrative. So yeah, there's a lot of things driving interest rates. The deficit is one of those things I don't think is this systematic black swan that some believe it is. But I do appreciate and acknowledge that every time interest rates go up, it is a fear. And that's the key of that 4.75 on the 10-year, or call it above 4.5 and higher, is that while many will argue the economy and markets aren't rate sensitive, when rates go to those levels and start going higher and people extrapolate and start talking about rate hikes potentially or less cuts, all of those issues that are rate sensitive flare up. And obviously housing is the most obvious one. The deficit is certainly another big fear. And then you've got real estate, lower quality, small caps, and even large caps, higher beta names tend to underperform as that breadth deteriorates. So that's why I believe we're between this channel, if you will, where rates, every time we get to 4.75 or 5, people start saying we're going to get to 6, get to 7. I don't think the economy or stock market could absorb rates much higher than 5. Thus, I don't think they're going to stay there. I think we're going to be basically reflexive when rates go up, and also reflexive when rates go below 4%. And that has to do with housing and how many issues are rate sensitive. And so I think we're stuck between 4 and 5% for the foreseeable future.
So I'll give you a 10th narrative that could happen, right? So you talked about how no one should care about the deficit and the debt. I'm not saying but you're saying they'll put it off and not worry about it yet. So you raise the debt ceiling $4 trillion, you're still running a deficit, who knows, $1 trillion, whatever the number is going to be a year, put it off. If rates start to move higher because the economy is slowing, that narrative is a disaster in terms of stagflationary environment. I'm not even saying that inflation runs hot. Yeah. I'm saying economy slowing means we can't pay our debts, or that would be the narrative I think that would be. I'm not saying that's going to happen, but that would be a scary narrative. Would you agree with that?
If we saw, so stagflation, again, that's been one of those, that's been the narrative, arguably maybe around
number 6,
the low in April when yields started going up and the stock market started going down. So my view of what stagflation is that it's unemployment rising that's not breaking the back of inflation. And I think there's a lot of different definitions of stagflation. Like sometimes we'll see the manufacturing PMI, the new orders will be down and the prices component will be up, and people will say, well, that's stagflation. Not necessarily. I think it's used a little loosely, but yes, that would be the worst environment for both the economy, for financial markets, seeing rising unemployment that is not able to bring down prices, particularly commodities and things like that.
So let's go to your hope trade. So H is housing, O is orders, P is profit, and E is employment. You just touched kind of on all of those a little bit. And I'm guessing in 2022, when you stayed bearish a little bit longer, you were really focused on those things. I'm guessing it kind of led you, which is not the wrong thing, but is what it is. So let's talk about it. You talk about how housing is and housing related are 16 to 17% of GDP.
Yeah.
Really had zero contribution. I mean, not zero, but it's been very low. So talk about that, and maybe in the back of my mind or in the back of your mind, when the Fed does start to lower rates, and they will at some point later this year, I would think. Hopefully they do it for the right reasons. I mean, you have inflation has peaked and you have a little uptick in unemployment. You would think that housing would get a kickstart. So let's break those 4 things down here. How you thinking about it?
Yeah. So housing, coincidentally, I think was if we got the Case-Shiller data today for the first time, we saw home prices drop for the first in 2 years. So housing, and the purpose of my hope framework, because a bunch of people follow me and I don't think they fully understand the purpose of it, or whether it's, quote, right or wrong. It's a framework. It's a set of ideas and a sequence. And, we, after 23 and 24, we didn't have a recession. And, I was writing a lot about it and kind of talking about the different data points and employment. I don't view it as it didn't work or it's not, it's broken. It's more of a confirmationary set of rules to keep you grounded and avoid some of the noise and the uncertainty. So, at the end of the day, over the last few years, has employment softened? Absolutely. Did it soften at the top part of the K? No. Did the economy go into recession? No, of course not. But at the same time, you can think about the soft versus hard landing debate, which is still going on. And, who knows, and everyone's been this year, obviously we had a lot of recession fear earlier when the markets were going down, and that's come off the boil. We still haven't landed in terms of how I look at things. And what a landing is when housing starts to rebound. And a landing in that context has happened before every single cyclical reacceleration in the history of US data, i.e. going back to the 50s. So I'll give you one example, like when the ISM goes back up and accelerates, which is the cyclical part of our economy, every one of those has been preceded by a substantial and obvious rebound in housing. And of course, those were preceded by a good amount of stimulus. The Fed cutting rates, we're doing QE, usually combined with lower commodity prices. So you get this somewhat of a downturn, you get this massive impulse from policy, and everything takes off. That hasn't happened still. So in my hope framework, we're kind of in purgatory, if you will. And again, I think it goes back to the bifurcation backdrop. But from here, I think, again, we're largely stuck. And I think housing's a big part of it. Because here's one of the things, and Powell hasn't said this, but my view is that one of the reasons, or I think there's two reasons he's going to be hesitant to cut rates as much as the people think he will. One, there's a lot of scar tissue from the last few years. And I think he'd rather let inflation cool further than potentially be the guy who cut and restoked it. So that's the first thing. The second thing is that if the Fed is going to cut rates because inflation predominantly, and not because unemployment's going up, if unemployment starts moving higher, my view that's green light, the Fed's going to cut. I think that's why they cut rates in September or beginning in September. You had 4 months in a row of rising unemployment. If they cut because of lower inflation pressures, I think that is going to lead to a sharp reaction function and reflexivity rebound in all the early cycle data, housing in particular. Because if rates are going to come down, not because people are losing jobs, that's going to be a positive for consumer confidence. There's a tremendous amount of pent up demand for housing. Yes, there's an affordability problem, but there's people that are waiting. And every time we have seen rates down, you've seen purchase apps pick up and you've seen the home builder sentiment pick up. So if they cut just because of inflation, I think they will create this kind of short-term mini cycle pickup in somewhat of a behavioral and macroeconomic response that will stimulate the economy more than expected. Inflation won't go down, much more. And I think it's hard to get inflation down a lot from where we are without higher unemployment. And I think that it's going to put them back in the same position where, okay, I cut rates a little bit, hopefully I got the long end to rally ahead of that or during that. And you'll see an immediate response from that drop in rates. Housing picks up, business sentiment, consumer confidence picks up, and all of a sudden the economy's fine again. And some of the inflation expectations, again, don't keep falling because the economy's fine. I think it's a tricky situation that is a bit nuanced because we've never had this housing backdrop where there's arguably a lot of people waiting on the side to get in, and they're just waiting for lower rates. And then on top of that, any homeowner who's bought in the last few years, who's got a mortgage rate that's 6-7%, they will likely refi or move towards refiing. Perhaps you'll get more people if the Fed cuts that will lower the price of a HELOC. So there's all of these things that could surprise us in terms of how much a little drop in rates could stimulate the economy. because again, I do think there are parts of the economy that are extremely rate sensitive, and they could be like a coiled spring.
Every cycle is different. This particular cycle had AI come into it and be the savior 2.5 years ago, whenever this thing started, right?
Yep.
A couple years ago. So no one could have predicted in 2021 and 22 what would be happening. Just from an earnings perspective now, it's a massive impact, right, on the S&P, and that's another part of your bifurcation theme. So talk about how AI has kind of replaced economic cycles in a way in this secular growth. I think that's really important.
Yeah, I'm grinning because I agree that it kind of just landed on the market and became this huge upside. My brother's going to kill me for doing this. I was having dinner with my brother in November of 20.
Little Cantro or big Cantro?
Big Cantro.
Okay.
Well, let me just be clear about that. He's older than me, but
I got it.
I believe I'm taller.
Okay.
So we were having dinner. I think must have been November, December of 22, and he works at Bank of America, and runs a big technology group. And he was showing me, I think it was DALL-E back then, and I don't know if it was ChatGPT or whatever was out then. And like I was like, wow, this is super cool. And first time I really had seen it. And anyway, that dinner happened. Did I buy any stock? Not early enough, no.
I was with a software person at dinner one night around the same time, and he goes, "You're not going to believe what happened." I go, "What is it?" He goes, "They released this ChatGPT." I go, "Whatever, who cares? The market's going to go. We're going into a recession." No, my point is, it is amazing the market how it searches and finds these things in these themes.
I want to make a point though about the market, because absolutely for the S&P 500, AI was a huge variable that led to outperformance, and particularly those stocks. However, though, I think it's important to recognize that when you look at the market from the lows in 2022 and the rebound in stocks, this is a fact that I think would surprise a lot of people. The S&P 600, the small cap index, the little brother of the 500, the multiple of the S&P 600 and the 500 from the lows went up the same amount. So all of the gains in the S&P 500 can be explained by earnings, which again, of course, largely came from those Mag 7 or AI stocks. But when you say, did it, the only comment I would disagree with that it necessarily saved things. I think it made things, perhaps it added to the confidence broadly speaking, but I think there was really inflation coming down, which again was the cause of the 2022 downturn stopping, which eventually led the market to rebound. And then that was the cherry and the nuts and on the top of the sundae.
Whipped cream.
The AI, yeah.
Yeah, but I would just say that it kind of replaced what you normally need, to your point, to really rally and have an economy grow. I'm saying was replaced, adds to your bifurcation thing, because it did have an impact on earnings. Maybe not necessarily the economic impact wasn't there. So Let's talk about your macro select portfolio, which you run at Piper Sandler in various groups, various different categories. What is it overweight right now? What is it underweight? And what's it telling you?
Sure. So back in 2018, we created this quantitative driven stock selection model. As a strategist, I wanted to get closer to our clients, i.e. giving them individual stock recommendations that were based on our macro and market views, as opposed to just saying S&P is going to go here and overweight, underweight these sectors. It's a lot more interesting, I think, to get down to the stock level. So we've been running that live. In 23 and 24, despite in much of 23 being bearish, we actually had the right positioning call, which was profitable growth companies. And so we held on to that view for a couple of years, and then kind of coming to this year, we changed it a bit. The tariff story certainly interrupted, I think, a lot of people's first quarter. And so we had to make a quick adjustment, which we did. And since then and through today, the 4 factors, so it's factor driven, are larger. So it's going to prefer larger companies, and it's sector neutral. So it's going to pick stocks within each sector that reflect these different attributes. So it's larger profitability. So companies with higher ROE, it's companies with stronger sector relative earnings revisions, and it's companies with higher free cash flow yield. So I would say it's a broad measure of quality is what we're trying to capture. And the view on those factors is that earnings remain extremely bifurcated. You're still seeing this year the S&P 500 cap weighted index is expected to grow earnings about double the equal weighted. And until we see I think the seeds of a broader earnings recovery, i.e. small caps picking up and just the breadth, where everyone's focused on market breadth, but what about fundamental breadth? That just hasn't been there in 2.5 years. So until we see that, we believe that you want to continue to favor these higher quality companies with a moat around their businesses that are more profitable, i.e. real simple. Had they been performing well coming into 2025? If so, they're probably going to continue to outperform, again, as a broad representation of their attributes in this backdrop where growth is bifurcated, it's not broad, interest rates are high, price levels are high, and we're not going to get this broad-based reacceleration in the economy. And I don't think we're going to get a broad-based downturn. So it kind of leaves you avoiding really cheap, low quality recovery type of plays, beta, book yield, small cap, but also avoiding super defensive parts of the market because ultimately you only want to own those if you're going to see a spike in rates, a spike in unemployment, or another event like tariffs, which again is hard to time. So it's more of a balanced approach. The portfolio is again sector neutral because we believe, and we show this a lot of very often in our work, that when investors gravitate towards a certain type of attribute, and they all tend to, regardless if you're a discretionary PM or a tech PM, you see it across markets. You see the same factors, the same types of companies. Think about the Mag 7. What are they? They're larger. They're very profitable. They've got a lot of cash flow. They've had strong earnings revisions. If you took those 4 factors and screened the Russell 2000 over the last 2 years, you would have done a lot better than the Mag 7. And the point is that smaller cap investors, or even investors that were buying smaller caps, that are typically mid or large cap focused, were buying the same types of names. And we think that's going to persist as long as the economy and the earnings backdrop is bifurcated.
And that's part market structure. Just funds are too large now to even go look in small and mid cap names. You bring up the point, though, looking at interest coverage ratios and why do all that work and brain damage yourself to your point where you can just buy these profitable large companies you get in and out of quickly.
Yep.
Valuation has never really been a great way to short, right? And it seems like the people are going to pay a premium in each sector for the best names because there's comfort in numbers. You feel safe there. So what if the thing used to trade at 23 times? Well, you know what? It trades at 35 times. You don't short it. So that's really interesting. Another theme to your bifurcated market, right? Of how you just have to pay a premium for kind of the best names that are out there. So I assume that's expressed in your model portfolio as well. Just in terms of what I'm saying is you don't sell something because it's trading at a certain valuation. Is it other factors that would lead you to? Okay.
Yeah, we do have for the last year and a half or so, we did add free cash flow yield into it. So call it a high quality valuation metric. And that helps to balance out some of that. But no, there's no strict rules, and 100% that we are not shy to recommend stocks because of other attributes like good fundamentals that happen to be expensive. And I remember back in 2011, we did this webinar and the title was The Death of Value. And every year thereafter, until 2019, up until COVID, basically, we'd do an annual webinar on this idea of growth versus value. And we were big secular bulls on growth. And the biggest pushback I'd get every time was that, well, the NASDAQ is so expensive. And it is, and it remains to be that case. And that's a largely result of the fundamental attributes in the NASDAQ. It's not like the TSX. It's not super cyclical and really cyclical fundamentals and a lot of leverage necessarily. So yeah, that's definitely something I learned fortunately early on, is that valuation is both a terrible market timer and on its own, not a great primary stock decision tool.
It feels like the stock picking, though, is occurring in the small and mid cap. And I know you just launched an ETF that you're advising on at Simplify, and it's small cap, right?
Yes.
And it's long only,
yes.
And it's actively managed, and the symbol is LITL. I know it just launched, so don't go in and look and say, oh, it's only at whatever million. But you're employing that type of strategy where you're running those factors about interest coverage ratios, everything is small cap. And I'd imagine that feeds off of all your experiences and what you guys are seeing.
Yeah, I think stock selection in the small cap space has generated a ton of alpha in the last few years, and I believe it will continue to. So as an asset class, I think with rates where they are, small caps are going to have a hard time broadly seeing outperformance from earnings. However, obviously, a lot of people want to have small cap exposure for various reasons. And at some point, we will see rates come down and a broader economic recovery. But we think this is a ideal time to be a stock selector, a stock picker within the small cap space, focusing on those more quality attributes. There's nothing wrong with small caps. My first job on Wall Street was on a small cap research team. And again, there's been some just massive home runs in the small cap space over the last few years. It's just that most of them, almost all of them, have earnings. And a lot of the way the index is constructed, there's obviously a lot of biotech, but there's just hasn't been a large number of smaller IPOs in recent years because money's gone to private equity. We really haven't had a cleaning of the market, i.e. a real recession since 2007, 2008. So there's just a lot of companies hanging around that are in the bottom part of that K because they survived on zero rates and then they survived a little more on all the COVID stimulus and they're still around. So we think it's a great opportunity to be a stock picker in the small cap space, looking for those companies that are performing well in this backdrop, and they are seeing a tremendous amount of outperformance because the fundamentals are so polarized within the small cap space. The S&P 500, you look at it and it's like they're all really good companies. They're all really well known. In the small cap space, if you were to do a distribution, the tails would be miles wider than what you see in large caps.
Interesting. And so let me ask you a question. I know they don't want to hear this simplify it, but is there a target AUM you want to be able to do it? Because if you get too big in a small cap ETF, it kind of precludes you from doing certain things or makes them. Have you thought about that at all or what the optimal size would be?
That's funny you mention that because it was one of the first things I thought of. Because again, I remember starting work on Wall Street in the early 2000s on a small cap research team. And one of the first jobs my former boss gave me to do was keep account of how many small cap funds were closing. And back then it was like 1 to 2 billion. This was like 03, 04, 05. And so, that could become an issue. That would be a blessing. I wouldn't say that. That could become a blessing. Let's leave it there. But we hopefully have plans to expand the offerings using our models. And but we wanted to start off with small caps. Of course, Piper Sandler is has the largest coverage in mid cap names on the street. So it's kind of goes well with the brand. So we're excited to start there.
All right. So I know valuation, I say doesn't matter, but let's just look at the S&P for a minute because I think you agree. I think it's pretty optimistic. $278 on the forward 12 months, $300, part of that $300 in 2026. Seems like a lot has to go right to get there. And I want to also throw in that other things you're watching, oil, which has been a huge beneficiary that's come down. It's been, it's direct tax when it's up. It's great when it's down. And the other stuff you've highlighted, kind of FHA stuff we've seen there and student loans. I mean, so just mix all that together a little bit for me and if that's a witch's brew or not.
Yeah, it's just getting more and more complicated
right.
As more variables start to influence. Maybe there'll be a K within the K of the consumer. So with earnings, if nothing changes, which of course that's not going to happen, something's going to change. But if nothing changes, the S&P will be up 8% between now and the end of the year, which means that the estimate for 2026 stays at $300. The multiple stays roughly at 21 where it is. There's an 8% difference between where the forward 12-month earnings expectations number is today, 278, to 300 at the beginning of next year. So that's an 8% potential gain. If things kind of quiet down, not too much, but we kind of stick the landing there. Guessing that we're going to see, as we typically do, at least outside of a big, broad reacceleration in the economy, is that those earnings numbers are going to continue to trickle lower. They have, in recent months or weeks, they've stabilized because things just got bombed out in April. We've seen soft data improve. So I think we're going to continue to see the soft data improve over the next 1 to 3, 4 months. Today's consumer confidence was a reflection of that. I'm kind of thinking of the order of operations where Trump talked about tariffs, sent the market down, sent soft data down, sent revisions down, got the Fed a little concerned, in reverse. So Trump's talked about tariffs in a good way, arguably. I've lightened them up. The market's ripped. And we've seen earnings revisions start to stabilize. The soft data is starting to stabilize. So I think the fears around growth will continue to moderate throughout the remainder of the year. I don't think recession's a risk. So I think we're going to see positive earnings. I think maybe 8% in terms of from here to the year end, maybe a little high in terms of how much those can change. Or let's say if we take the 300 number, I wouldn't be surprised to see that down, 5% by the end of the year.
And then just kind of the student loan stuff, the impact this stuff could have kind of maybe it's on the lower end consumer, the lower part, which again leads to your bifurcation. It's not big enough.
It's not big enough, but it creates more reflexivity because now you've got an 8% delinquency rate on student loans, roughly around there. The FHA, some of the forgiveness programs are coming or have come off, and there's more to come off later in the year. So that will fill up the bottom part of the K. But again, it just adds to that reflexivity. The list of things that are going to benefit if rates come down, particularly from a good reason, i.e. inflation, keeps getting longer.
Sounds good. Well, Kantro, I can't thank you enough for coming on. You're always thoughtful in your work. Like I said, you can find your podcast weekly, What's Next for Markets, which I think is a great way, honestly, to start the week. Yep. It's not long either. It's like 16, 18 minutes sometimes. Don't go longer than that. I think it's great. And then obviously, I was not joking in the beginning. The one ranking that matters the most is institutional investor. It's your peers. It's the large fund managers that I think that vote that are part of that process, right? The large institutions. And so that's not a fluke. So I wish you luck to repeat a little back-to-back in 2025. So keep doing what you're doing. Thank you, Michael.
Great hanging out with you, Danny.